This report provides a comprehensive analysis of Freehold Royalties Ltd, FRHLF on the OTC market, FRU on the TSX, a leading North American energy royalty company. The analysis concludes that Freehold offers a distinctive investment profile characterized by high cash flow stability, exceptional margin integrity, and a robust, sustainable dividend stream, despite anticipated near-term cyclical commodity headwinds. The core investment thesis rests on the unique resilience of the non-cost-bearing royalty model, which effectively insulates profitability from inflation and operational cost volatility common in traditional exploration and production E&P sectors. Freehold's strategic pivot toward high-value liquids production, coupled with a deep, diversified inventory base spanning decades, positions the company defensively during commodity down cycles while maintaining significant opportunity for growth through accretive acquisitions. The investment case is supported by several structural advantages. Exceptional margin quality. As a passive royalty owner, Freehold incurs zero capital, operating, or abandonment costs, enabling the conversion of virtually 100% of realized revenue changes into funds from operations (FFO). Robust development pipeline. The company controls substantial development inventory estimated at approximately 40 years in Canada and 30 years in the United States. This longevity minimizes reserve replacement anxiety often associated with traditional E&P entities. Sustainable income focus. The fixed monthly dividend of 0.09 per share is strongly covered by FFO. Management targets a conservative payout ratio of approximately 60% of FFO and has stress-tested the dividend floor, confirming dividend sustainability down to roughly US $50 per barrel BBL WTI crude oil. Strategic liquids optimization. Freehold has successfully transitioned its production mix, increasing liquids weighting from 55% in 2020 to a targeted 66% in 2025. This focus on higher-value hydrocarbons results in each barrel of oil equivalent, BOE, generating nearly 20% more revenue than in 2020 and contributes an estimated 3% increase in FFO per share. Investment risks. Crude price sensitivity. The primary exposure is to global crude prices, which drive approximately 94% of corporate revenue. Global forecasts anticipate a decline in Brent crude prices to US $52 per barrel in 2026, posing a near-term challenge to the US $50 WTI dividend coverage threshold. Operator drilling activity. Although Freehold benefits from diversified operators, FFO growth is contingent on the capital discipline and drilling efficiency of its 380-plus counterparties, particularly in the key U.S. basins. Valuation discount. The persistent disconnect between the company's long-term intrinsic value, multi-decade resource life, and its cyclical valuation multiples presents a risk that the market may fail to adequately re-rate the stock, especially during periods of commodity weakness. The Q2 2025 financial results demonstrated the inherent resilience of the model. While the 11% drop in WTI prices quarter over quarter resulted in a proportional revenue decline, the FFO generated, $0.35 per share, continued to strongly cover the $0.27 quarterly dividend. This performance validates the management stress test floor and confirms that the minimal cash cost structure protects the FFO netback, allowing volatility to impact gross revenue without immediately endangering the core value proposition of dividend stability. Freehold Royalties manages one of the largest non-government portfolios of oil and natural gas royalties in Canada, complemented by an expanding land base in the United States. This passive ownership model provides a fundamental cost advantage unmatched by traditional E&P companies. As a royalty interest owner, Freehold is fundamentally exempt from bearing any capital costs associated with drilling and completing wells, operational costs required to maintain production, or long-term liability costs related to land restoration and abandonment. This absence of operating and maintenance expenditures is the foundational driver of Freehold's superior cash margin profile. Royalty payments are received from over 380 diverse industry operators, ensuring that counterparty credit risk and operational execution risk are highly dispersed across the portfolio. The company maintains an active portfolio management approach focused on business development, utilizing aggressive leasing programs, and executing accretive acquisitions. For example, in the second quarter of 2025, Freehold signed 40 new leases, 34 in Canada, 6 in the U.S., contributing $1.9 million in revenue for the quarter and $5.8 million for the first half of 2025. Since the royalty model eliminates production and operating costs, the net revenue, $50.06 per BOE in Q2 2025, is functionally identical to the gross operating netback, confirming the best-in-class margin profile. The company benefits significantly from its U.S. portfolio, which realized an average price of $57.83 per BOE in Q2 25, reflecting a 31% pricing premium over the Canadian realized price, $44.23 per BOE. This premium is attributed to the higher quality crude oil, reduced transportation costs, and high liquids weighting in the U.S. portfolio. A critical source of competitive advantage lies in the low tax burden on U.S. revenues. While U.S. jurisdictions like Texas assess flat ad valorem and production taxes on commodity revenues in lieu of corporate income taxes, the tax expense remains minimal relative to the realized price, $1.81 per BOE in Q2 25. This ensures that the high U.S. pricing premium is largely preserved, acting as a crucial driver of overall corporate netback and FFO quality. Freehold is strategically positioned as a leading North American royalty company holding approximately 6.2 million gross acres in Canada and exposure to approximately 1.1 million gross drilling acres in the U.S. This substantial acreage underpins the company's extensive resource life, providing approximately 40 years in Canada and 30 years in the U.S. A key strategic initiative has been the continuous shift in product mix toward higher value liquids. This transition has successfully moved liquids weighting to an expected 66% in 2025, up from 55% in 2020, aligning the revenue profile with premium crude pricing. In Q2 2025, liquids accounted for 67% of production volume. Furthermore, oil and natural gas liquids represent approximately 94% of the company's year-to-date 2024 revenue, demonstrating a high degree of oil-weighted focus. Operator quality and concentration risk. Freehold's asset quality is enhanced by the caliber of its counterparties. The company benefits from having high-quality, well-capitalized producers on its royalty lands, including ConocoPhillips and ExxonMobil. The exposure to ExxonMobil is particularly noteworthy, as the major is cited as the company's number 3 payer and controls approximately 35% of the development inventory in the prolific Midland Basin. This concentration of development activity with large-cap integrated energy companies acts as a material operational de-risker. In periods of broad commodity price weakness, as forecasted for 2026, smaller E&P entities typically slash capital expenditures abruptly. By contrast, globally diversified majors like ExxonMobil possess superior capital resources and lower break-even operations, allowing them to sustain development activity even during market downturns. The continued advancement of the 35% controlled Midland inventory provides a crucial layer of stability to Freehold's U.S. FFO stream that a royalty company reliant on junior or mid-cap E&Ps might lack. Furthermore, while Freehold's valuation is predominantly driven by its oil exposure, 94% of revenue, the simultaneous market shifts in natural gas pricing offer latent value. Historic weakness in AECO natural gas was a persistent valuation discount factor. However, the forecast recovery of the AECO C benchmark price to C3.82 per gigajoule (GJ) by 2026, coupled with strengthening Henry Hub prices, means that the remaining natural gas portion of the revenue base will become significantly more valuable without requiring any corresponding capital outlay from Freehold. This natural gas tailwind provides a potential boost to FFO that is currently not fully captured in oil-centric forecasts. Financial performance and operational netbacks. Freehold reported strong operational performance in the second quarter of 2025, achieving 16,584 BOE per day, marking a 9% increase year over year. However, the quarter was marked by a challenging commodity price environment characterized by an 11% drop in WTI oil prices quarter over quarter. This price decline resulted in volatility in reported financial metrics. Royalty and other revenue decreased substantially to $78.3 million in Q2 2025 from $91.1 million in Q1 2025. Net income experienced a disproportionate decline, falling from $37.3 million in Q1 25 to only $6.2 million in Q2 25. This extreme volatility in reported GAAP net income, despite strong underlying operations, confirms that traditional P/E ratios are often unsuitable for valuation in the royalty sector due to the outsized impact of non-cash charges, such as depletion, depreciation, and impairment. 3B, Funds from Operations and Netback Profile. Funds from Operations, FFO, is the critical metric for assessing the stability and quality of a royalty cash flow. FFO proved robust in Q2 25, reaching $57 million or $0.35 per share. This cash flow stream is the primary source for dividends, strategic acquisitions, and debt reduction.
Balance sheet health and deleveraging. Freehold's financial strategy is centered on maintaining a strong balance sheet to facilitate continued accretive acquisitions. The company operates with a highly conservative leverage profile relative to its peers. At the end of Q4 2024, net debt stood at $282.3 million, following cash used to partially finance a significant December 2024 acquisition, resulting in a net debt to trailing FFO ratio of 1.2x. The subsequent quarter saw rapid deleveraging, demonstrating the high-margin immediate accretion of the acquired assets. By Q2 2025, net debt was reduced to $271 million, lowering the leverage ratio to 1.1x trailing FFO. The rapid reduction in leverage following the acquisition confirms that management's capital allocation decisions are sound. The assets acquired are genuinely accretive and immediately begin delivering high-margin cash flow. This ability to quickly revert to the low end of their leverage comfort zone validates the company's disciplined growth strategy. Capital allocation and dividend strategy. Freehold's history as a consistent income provider spans 29 years, having always paid a dividend since its initial public offering, IPO, in 1996. The company currently pays a fixed regular monthly dividend of $0.09 per share, equating to an annual rate of $1.08. This yields an attractive 8.0% based on Q2 2025 share price levels. The management target for the dividend payout ratio is conservatively set at approximately 60% of FFO. Dividend coverage resilience. A critical measure of sustainability is the management-disclosed stress test threshold. Freehold's dividend is explicitly designed to remain covered even if WTI crude oil prices fall to approximately $50 per barrel. This floor is highly relevant given the prevailing macroeconomic outlook. The leverage ratio remains low, 1.1x FFO, providing significant financial flexibility to withstand commodity volatility without resorting to either debt covenant issues or forced dividend reductions. The company also employs a normal course issuer bid (NCIB) share buyback plan, providing management with an additional tool for opportunistic capital return when shares trade below management's assessment of intrinsic value. V. Macroeconomic outlook and commodity price assumptions. The forecast for the energy complex presents a mixed picture for Freehold, with expected headwinds in global crude oil largely offset by structural improvements in key Canadian energy markets, AECO gas and WCS crude differentials. VA. Global crude oil headwinds, WTI, Brent. The Energy Information Administration, EIA, forecast indicates significant downward pressure on crude oil prices through 2026 due to rising global inventories. Price projection. Brent crude oil prices are forecasted to fall to an average of $62 per barrel in Q4 2025 and further to $52 per barrel in 2026. Supply dynamics. Global liquid fuels production is projected to increase, primarily led by non-OPEC Plus countries, which are expected to add 2.0 million barrels per day (BD) in 2025. U.S. crude oil production hitting a record high of over 13.6 million BD in July further exacerbates the supply glut risk. Since Freehold's dividend coverage floor is $50 per barrel WTI, the forecast decline to the low 50s range means the dividend distribution may be tested. However, the existing buffer and low leverage minimize the risk of a forced reduction. The company also employs a normal course issuer bid (NCIB) share buyback plan, providing management with an additional tool for opportunistic capital return when shares trade below management's assessment of intrinsic value. VB, Canadian crude oil mitigation, WCS differential.
Positive developments in Canadian oil export capacity provide an essential counter-cyclical element to Freehold's portfolio. TMEP impact. The commercial operation of the Trans Mountain Expansion Project, TMEP, in May 2024 has positively affected Canadian crude oil differentials, WTI minus WCS, by reducing the risk of total supply exceeding takeaway capacity in the Western Canada Sedimentary Basin. WCS outlook. The narrowing of the differential is expected to mitigate the impact of the global crude price slump on Freehold's production. The WCS price, under a base tariff case, is forecasted to improve from US $45 per barrel in 2025 to US $48 per barrel in 2026. VC, natural gas tailwinds, AECO Henry Hub. The recovery expected in natural gas prices provides a crucial hedge against crude volatility, particularly benefiting Freehold's substantial Canadian landholdings. AECO forecast. After averaging a historically low CDN 1.45 GJ in 2024, the AECO C price is forecasted to rebound aggressively to CS 2.71 GJ in 2025, rising further to CS 3.82 GJ in 2026. Henry Hub trend. U.S. benchmark Henry Hub prices are also expected to strengthen, rising from approximately $3 per million British thermal units MMBTU to $410 per MMBTU by January 2026. The highly divergent forecasts for crude, bearish, and natural gas, Canadian differentials, bullish, neutralizes the overall commodity risk profile for Freehold better than for a pure-play oil or gas royalty company. While the 94% liquids revenue base faces pressure from the global crude downturn, the strengthening realized WCS prices and the significant recovery in the AECO price directly bolster the Canadian asset base, providing an inherent, natural hedge against expected light oil cyclicality. Valuation analysis and peer benchmarking. Given the volatility of reported net income caused by non-cash charges inherent to the royalty model, valuation relies heavily on cash flow metrics, specifically P per FFO and EV per EBITDA. Freehold is benchmarked against its North American royalty peers, including Prairie Sky Royalty, Topaz Energy, Kimball Royalty Partners, and Viper Energy Partners. The valuation multiples reflect a premium over typical E&P companies, which is justified by the higher certainty of passive cash flow, minimal capital requirements, and guaranteed operational cost avoidance. Intrinsic value and target price derivation. Analyst coverage suggests a high degree of confidence in the stock's future performance. Projections from 13 analysts place the average 12-month target price at C15.88, with a tight forecast range from a low of C14.5 to a high of C22. This consensus target suggests an approximately 12% upside potential. However, intrinsic valuation models reveal a deep disconnect between the current market price and the calculated asset value. An independent DCF analysis estimates Freehold's fair value at US $29.55, implying that the stock is currently trading at a 65.7% discount. This stark contrast highlights a structural mispricing rooted in how a market values assets with perpetual, multi-decade cash flows. The market typically struggles to value the perpetual stream and 30 to 40-year reserve life using short-term cyclical cash flow metrics like trailing EBITDA or P per FFO. The high DCF valuation suggests that the true value of the undeveloped resource base and long-term royalty streams is significantly higher than currently reflected, representing a powerful long-term buying opportunity if oil prices stabilize post-2026. The analyst consensus target of C15.88 is adopted as the conservative, market-pragmatic target, incorporating expected near-term cyclical pressures while still recognizing the high quality of the underlying asset. Investment risks. Commodity price volatility. As 94% of revenue is liquids exposed, the single greatest risk remains a sustained decline in WTI crude prices below the US $50 per barrel floor. Regulatory changes. Changes to royalty collection regimes or the introduction of new tariffs, such as the 10% U.S. tariff on Canadian energy products mentioned in the AECO forecast, could adversely impact realized netbacks and future revenue streams. Operator execution. While exposure is diversified, any collective industry decision by key Permian and Canadian operators to significantly curtail capital programs in response to sustained price weakness would slow Freehold's production growth trajectory. Acquisition execution. The continued success of the growth strategy hinges on management's ability to identify and execute accretive royalty deals without overpaying. Erosion of the strong balance sheet through inefficient acquisitions would compromise both dividend security and future growth potential. Conclusions. Freehold Royalties Limited represents a high-quality, dividend-focused investment vehicle within the energy sector, offering structural protection during volatile market cycles. The company's non-cost-bearing model translates directly into a best-in-class operational netback, ensuring that FFO remains robust even when faced with sharp commodity price declines, as demonstrated in Q2 2025. The anticipated global crude price weakness in 2026, driven by EIA forecasts of increased non-OPEC Plus supply, poses a cyclical headwind. However, this risk is substantially mitigated by the company's conservative financial structure, its adherence to the U.S. $50 per barrel WTI dividend coverage threshold, and the positive structural tailwinds from improving Canadian pricing dynamics, narrower WCS differentials, and AECO gas recovery. The market appears to be assigning a cyclical valuation to an asset base possessing fundamentally perpetual cash flow qualities. The material difference between the consensus target C15.88 and the intrinsic DCF value US $29.55 suggests that the company is currently significantly undervalued based on the long-term quality of its multi-decade inventory.